Hello, everybody. So, folks, the stocks I cover on the channel require a strong heart. The market is brutal with hyper growth. The market trades on vibes. It doesn't really trade on, the merits of deals or what's going on under the hood. And of course, Reax from 52 weeks ago, it's down about 60%. Which is par for the course. I mean, the stocks I cover on the channel, think about HIMS, for example. Unfortunately, the past 7 months have been absolutely brutal for hypergrowth stocks, for innovative companies, innovative stories. And I think Reax is one of this case where, the CEO is like, whatever, I'm going to run the business the way I want to run the business. Because he hasn't been, that CEO hasn't been rewarded in terms of stock price. The fundamentals of the Real Brokerage is growing super fast. Just the other day, I saw another Real Broker in my neighborhood. They're winning, in my view. The Real Brokerage is winning, right? I think they're doing better than Open Door. If you look at the numbers are stellar. The revenue growth looks like a HIMS, looks like a SoFi. But of course, this market gives no respect to these type of companies. And so the CEO is probably like, well, you know what? Never mind. We're going to do an acquisition. It doesn't matter if the stock price doesn't matter. And of course, the stock price is down 27%. Keep in mind, the stock price could have been down 27% because earnings would have been off by 1 penny. That's also something you could have seen. Right? You could have said something on the call unrelated and the stock price could have been down 27%. I mean, these stocks are brutalized by the market, and the market, I don't think, is just judging them on their merits. Over the long run, stocks are weighing machine, but the definition of the long run, it's not 1 to 2 years now. The long run nowadays, maybe a decade, right? That might be the time you need for the stock market to actually weigh stocks like a weighing machine and not like a voting machine. Anyway, so today what did they do? They acquired REMAX. Now, if you're in the US, you know REMAX. But the odds are you could have bought a house with them. I'm pretty sure I have. But I don't care about brokers. But I'm pretty sure I bought a house for a REMAX broker one time, a few years ago. Anyways, I know I haven't with Real. I haven't bought a house in a while. It's like we're all stuck with real estate right now because the real estate market is awful right now, absolutely awful. And so what's going on? The Real Brokerage is using an opportunity right now of awful valuations in the real estate market. It's using this opportunity. They're using their pristine balance sheet to buy, what I guess I would have called a competitor yesterday, right? Which I guess they're not a competitor anymore now, but I would have called REMAX a competitor of Real. And of course, REMAX is a franchise. And from what I understand, they used to be a more innovative franchise that grew pretty fast in the analog days. And the founders, this is a pretty old company now, and the founders are pretty old. But in the pre-internet days, in the analog days, from what I understand, REMAX used to be pretty good at what it did. And the Real Brokerage was like, okay, I'm going to buy it. And of course, Mr. Market being Mr. Market, algos being algos, acquisitions bad, new shares issued bad, dilution bad, CEO may be building an empire, synergies are exaggerated. And of course, Reax has never gotten any respect from Wall Street. And what? We thought we were going to get respect for that? No. This stock has never gotten any respect from Wall Street. And Wall Street is often quick with these things. Like when you say acquisition's bad, large acquisitions tend to be bad, not small ones. Now, for Reax, this is like a medium-sized acquisition, but acquisitions are not always bad. They tend to be bad when they are very large, like AT&T buying Time Warner. Like that's really bad. But for this, in my view, the way I look at this is, I think the CEO had an opportunity to acquire an asset on the cheap, like on the absolute cheap, because they didn't pay a lot at all on this acquisition. And the bet is, if you think real estate is going to be in a glut for another 4 years, if you think for another 4 years there's going to be more pain in real estate, then anything related to real estate should not be touched whatsoever. If you think real estate is going to continue to be awful for the next 4 years, you should not touch anything related to real estate. And this stock, I think, is trading mostly on sentiment related to real estate. And it's clearly not trading on the fact that the top line of Reax has been stellar. The agents joining Real Brokerage have been stellar. This company has been growing stellarly under the hood. But the stock is trading based on what the market thinks real estate is doing and real estate is going to do. But they've had organic growth in a very, very tough market. So the way I look at this is, I think the CEO looked at a deal. They were like, okay, this seems like we have a pristine balance sheet. This seems like a good time to buy a competitor on the cheap. And of course, realize synergies, because what Real has been building on the back end, the app, the more efficient broker platform. I think they said on the call they had something like 90 agents per employee versus the top competitor in the field has 14 agents per employee. So Reax is a digital native, highly efficient back end. And of course, REMAX has been trying to build its own, but what they're saying is that, they will operate the back end of REMAX. Eventually, the tools of the Real Brokerage will be introduced to the back end of REMAX, and the brand REMAX will remain the same, and it will be still REMAX, but it will be powered on the back end with what Real has built. And so that's the strategy in a nutshell. But I want to point out the steal. I mean, this is so cheap. How much did they pay? They pay 7 times synergized 2025 EBITDA, and I think they calculate that because of something like a 30 million synergies that they're going to achieve. Very good. Very good. Run rate cost savings. By merger, they're doing 30 million in run rate cost savings. So if you include those, that's 7 times adjusted EBITDA. So 7 times cash flow. Absolutely dirt cheap. Calculate the cash flow yield on that, right? Absolutely dirt cheap. We're talking about very high rates of return. CEO mentioned the acquisitions called, of course, that this is on a depressed run rate. Real estate is in a crisis. This is on a depressed run rate. Once transactions pick up, once real estate transactions start to oscillate again, and that unlock is, of course, achieved whenever the rates drop, is when we achieve that unlock. Once real estate oscillates again, the revenue rate of REMAX will be much higher than it is today. And so will be the adjusted EBITDA. So this is a bet on real estate transactions picking back up, right? And of course, this is something that will happen only when interest rates drop. If you look, there's also another advantage. It's an asset-light franchise model, and for REMAX and for Real buying it, and they are going to make a lot of money from franchise fees as opposed to commissions. It will be a lot of franchise fees making money. So this is actually going to change the revenue mix of the group, of the combination. And this is where I think it gets interesting. Like you can see, like right now, the gross profit composition of Real Brokerage is 95% commission, 5% title. And this is gonna change. The revenue composition is gonna change because you are going to have franchise fees 52%, dues, commissions 24%, 10%. That's what you're going to be adding. And so the group is going to be 55% commission. So by doing this, and this is roughly like a 60-40% merger of a way to look at it, like it's going to be a 60% Reax, 40% REMAX. If you look at when you combine the two, if you look at REMAX only does 24% from commissions, right? Real does 95% commission. If you combine the two, then you have a new business with a combined adjusted EBIT margin of about 7%. So Real is moving from about 3% EBITDA margin to about 7% EBITDA margin. And that's a more stable business because the franchise dues are now going to take 29% of the margin is going to be a franchise dues. So you're diversifying. Right, you're going to be diversifying the revenue base, and this should theoretically remove some risk, and theoretically Wall Street should be happy about that. But of course, this is not how these stocks trade. These stocks trade on vibes. right now. It takes a very long time for these stocks to be weighing machines. Also, I want to talk about that. Of course, is the technology. Their technology, the technology platform on the back end will be expanded to REMAX. This is where a lot of the cost savings will come from, and hopefully efficiency improvements for REMAX as well. Also, and I will continue this, they had a pristine balance sheet, a net cash position. Now they're going to be in debt because they're buying the stock. So they're buying the REMAX stock. So they're going to be in debt. So after they buy it, when the pro forma company will be announced, so both companies together, it will be 2.7 times EBITDA. So a little bit higher leverage. Their goal is to get below 2x leverage, and so hopefully that can be achieved really quickly. So after the acquisition is done, their goal will be a reduction of debt and debt reduction. So that's an added little risk, is that the company who had a net cash position, who is now going to have some debt that they need to reduce. Now, of course, was this company getting any credit for a great balance sheet? Were they getting any credit for a great balance sheet? Absolutely not. They were getting no credit at all for a great balance sheet. So why would you bother if you were getting no credit at all? So what I will say over the short run, and that I will say about Reax, is that this is the type of stock that you cannot own if you don't have a super diversified portfolio. Like this is a small position for me, and I think this ought to be a small position because this type of stock moves so quickly to the upside and the downside that if you make this anything meaningful in a portfolio, that could really hurt you. And I think also that over the short run, this is the type of stock which is a bet on the real estate market recovery, and the market will treat it as such. So one of the key questions to be invested in this sector is, will real estate pick back up? If real estate picks back up, that means the REMAX revenue will increase. It will normalize. It will go back to the level that it used to be. Real estate picks back up, realistically, when the Fed drops the rates. Why? Because right now you still have people who are locked in, 2.75% mortgages, and now mortgages are 6%, so they don't want to move. You unlock a bunch of people. There's a bunch of people who want to move who don't move right now. And they don't move because they have that mortgage that they want to keep, right? You unlock a lot of real estate transactions from the moment the rates drop, right? People are okay moving if they switch from a 2.7% mortgage to like a 4% mortgage. It's a tougher sell if they switch from a 2.75% mortgage to like a 6% mortgage. That's a much tougher sell. And I'm using my situation here. I have a 2.75% mortgage. There's no way I'm selling my house. 2.75%? Are you kidding? No way. Absolutely no way. Rates are 6% now. But if rates were 4%, I'd be like, okay, I'd move. Yeah, and I think a lot of people are in this situation, especially in states like Texas. In a lot of states, in a lot of regions, a lot of people are in these situations where they want to move, they want to upgrade, downgrade, they want to do all of these moves, but they don't want to get a terribly worse deal on interest rates. So this is a big play on interest rates going down. Will the rates drop? Will they? How bullish are you on Kevin Warsh? I'm pretty bullish on Kevin Warsh. I think he's going to drop the rates. If he does, real estate recovers. And also, what is your view on the asset class over a very long run? My view on the asset class is that as annoying as home insurance and as annoying as taxes are, this is still a hard asset, right? Real estate is still hard. Right, it's not as hard as Bitcoin. It's definitely not as hard as Bitcoin. It's arguably not as good as stocks. But given that you don't have a choice, given that you have to live somewhere, it's kind of like the best of both worlds. I don't know what to say. The risk is, will real estate recover? I think because of the insane monetary printing we're going to have at some point, and I don't know if it's in 2028 or in 2032. But the insane monetary printing we're going to get at some point, in my view, will inevitably make real estate go up. But to me, this is a ultra long-term hold. My Reax position is a super long-term hold. Like it's perhaps one of the longest-term ones, Because look at a stock like Tesla. People are upset because Tesla keeps delaying by 6 months what's going to happen with a catalyst at Tesla. For the case of Reax, the catalyst could be 4 years out. So you have to be willing to be sitting on this for 4 years, right? The catalyst could be 4 years out on this stock. I have no idea when the catalyst is coming. I know that the catalyst will, I don't know, but I'm pretty sure at one point the catalyst will come, which is real estate unlock. And then when real estate gets unlocked, who's going to oscillate fastest? Who's going to capture the most of the transactions? The real estate changing hands. I think Reax and REMAX now, I guess, together will attract a lot of these transactions, and we could have boom times. And maybe the stock gets overheated during boom times. And if the stock gets overheated during boom times, then I'll exit. Anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.